Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Good morning, Devina.
Good morning, Neeraj. And we missed out the day's trade yesterday. We've got lots to catch up to in terms of the volatility for sure. But the US markets, and just to give you a quick setup of what we're looking at in terms of the overall market mood globally, Tuesday saw this big sharp rally coming across in the hopes of some big stimulus coming in and the US administration passing zero tax on payroll. And that's something that the street was expecting. But then what crept in was nervousness regarding the timing of that package. So most of the gains, at least in the Dow futures, and what it's suggesting is that you're going to likely see that little bit of scare coming back into the equity market. So down about 2% odd. Asia as a pocket, no major reaction to the US equity markets as well. So Asia is flat. China is just about up at 34%. Hang Seng is up marginally, and Nikkei 225 is down in the session by about 1% or so. All this while we've been talking about how U.S. Treasury yields and the fact that it's come off sharply under 1% is where most of the money is moving in because of the safer haven assets. The common voice seems to be suggesting this could actually be a silver lining because the cratering of the U.S. yields could push investors towards stock which have higher dividend yields. And as of the close on Friday, you had 3/4 of the S&P 500 companies trading with dividend yields higher than the US Treasury yield. Whether that happens or not and whether that pushes investors to buying stocks is something we'll have to see. For SGX Nifty, for our own Indian markets, the cues that we're taking now is that we've got a percent cut. This is yesterday's close. This is about 10,400 that we've got on the SGX Nifty.
Yeah, but let's wait and watch. As we said in the trade setup as well, the weekly moving average, 200-day weekly moving average remains the key determinant, and let's see what happens there. But that's for the Indian markets. What about the global sentiment per se? First, let's get that going. Richard Harris of Port Shelter Investment Management joins us right now on the show with his thoughts. Richard, good having you. Thanks for joining in. A quick sense, the markets were anticipating some announcements. Donald Trump absent in the press conference as well. That's brought the futures down. Would you reckon that if some announcements come in, there could be a bit of a bottoming out process, or is it difficult to call right now?
Well, I think the problem is that the U.S. authorities, certainly the White House, seems to be at sixes and sevens. They don't really seem to have a particular policy, don't seem to know what they're doing. They seem to be fighting a rearguard action. And Trump's tweets are clearly not helping because, on the one hand, they seem bullish. On the other hand, there seems to be no action following that up. So I think the sentiment coming out of the White House is rather poor. In terms of where the markets are going, we had a rebound yesterday, but I think today is going to be very important to see whether the markets are going to bottom out, maybe, with a 2% fall or something like that, which we're seeing in the futures at the moment, or whether they will see a much bigger fall today. I think the odds are probably still that the markets are going to go down, but we could see maybe a bottoming out midweek, just for everybody to catch a breath.
Richard, this is also a time where you're having contradictions within. So on one hand, just a few weeks ago, Stephen Mnuchin said that this is not like the financial crisis, and therefore to expect a big economic stimulus, this is this will play out in its own course of time. This is a time-bound event and therefore may not warrant such big actions. And then you have Donald Trump coming in and saying that they're going to looking at zero payroll tax. So do you feel that this, as well as the fact that even if such a measure is put into place, it will take time to play out, and by the time it's come into effect, the market and the uncertainty there will already play out its course?
Well, this is an evolving process, and it's going to be difficult to hold policymakers to things that they were saying a little while ago. I mean, policymakers are in a difficult position. If it's a serious event, on the one hand, they must act seriously and decisively and boldly. On the other hand, if they do that, they're terrified that the general population is going to be spooked and take fright, especially the markets. So the Fed a couple of weeks ago cut rates significantly by 0.5%. thinking they were bold and dominant, and all they did was spook the markets. So it's a very difficult situation for policymakers. I think what is also going to be, it's clear that governments are going to come in with a lot of fiscal support. That, of course, is going to add to the debt burdens, which have to be unwound sometime at some point. So that's difficult. But I think that governments will come in and provide liquidity support to try and avoid the kind of credit crash that we did in 2008. So I have some sympathy for policymakers and their pronouncements, but I think, we have to see what they do rather than what they say.
Richard, what is the expectation then from the Fed on the 18th of March, and where does that leave equity market investors?
Well, everybody's been saying, interest rates have to be cut, but the last cut did no good at all. Indeed, it spooked the markets, and further cuts, are only going to mean that the Fed has got less ammunition in the future. The markets seem to be convinced that the Fed is definitely going to cut. I'm not so sure. I think that there's still a possibility for them to turn around and say, well, we're holding our powder at the moment because the government is doing stuff. So I'm not so sure the markets would be terribly concerned by the Fed not cutting yet again, because I think it's generally understood that cutting interest rates is not going to solve this problem.
It's more of a demand and supply shock, and fall in interest rates. I don't know how much more it can do to address that issue. Thanks very much, Richard, for joining us this morning.
Pleasure.
Richard Harris there of Port Shelter Investment. But remember, while we've been talking about all of these issues, historically as well, every time the markets has moved into a bear market or there's been a sharp correction, the ensuing rally has been a big one. So for the year, once you place your bottom, you've got good gains of about 30% plus on most occasions. But whether or not it's the bottom yet, that's anyone's call to make.
Yeah, it's Kotak Securities doing that. Rasmik Oza Johnson right now with his thoughts. Rasmik, good having you. Thanks much for joining in. Bit of a difficult time right now, but I'm just wondering, are you telling your clients to go out and make large purchases or just sprinkle them over the next few weeks?
Good morning, Neeraj. Good morning, Devina. Definitely, we've started telling clients to chip into the market and accumulate on every declines. I think we've gone through much of the pain. I think we need to just break down this into two parts. One is the global impact. Obviously, there will be global slowdown, and there will be concerted efforts by government, central banks to come and probably soothe the nerves and provide whatever is required in terms of either cutting interest rates or by putting liquidity. I think looking at global yields and global interest rates, maybe the incremental impact of lowering interest rates may not be that meaningful going forward. But when it comes to India, I think there could be a lot in store for India once the dust settles down. I think India will definitely stand out, one, because of the crude. I think our economist calculations that for every $5 per barrel fall in crude prices, we have a positive impact on the economy and the current account deficit by around $7 to $8 billion. So if you're looking at last year's peak of $70 to around $35 low, probably, and even if you take a mid path, I think India could almost save around $15 to $20 billion. It could be a stimulus where savings could, I think, gradually flow down to the customers. Two is, I think our yields are still pretty high at 6%. A lot of room for RBI to cut rates going forward, which will have a meaningful impact on the economy. Next, I think so. Today only we have released a strategy report saying that the entire impact of this crude fall on earnings could be very positive. So almost around 12% net positive impact on earnings of FY21 because of the fall in crude prices. That will also materially benefit. And then coming to valuations, I think 2018 somewhere we hit the low end of 16 times on 1 year forward. I think we're just slightly above that and close to the 10-year averages. And meaningfully, I think so both the bond yields and the equity yields have converged, and now the equity yield is slightly higher than the bond yield.
Right.
So if you put all this to factor, I think so maybe we are close to the bottom, 10,000 to 10,300 somewhere we'll form a bottom. It's a great time to start investing. And if you go by the last 7-8 precedences of all these epidemics or pandemics, I think the recovery has been equal or more than the fall what we have seen. So right now, probably, yes, we'll have some more cases coming of COVID-19 in the next 1 month, 1.5 months. Probably what we've seen in China, if you go by, after 2 months it's subsiding.
Sure.
So maybe it rises in February, escalates in March, and then subsides in April.
Okay, well, let's wait and watch. I mean, one would pray that that happens to some of the other economies as well. So that's the mood, larger index call. Now let's talk about specific things as well. And before I get to Rasmik on that, let me go across to our research team to talk about the key stocks in news today. And there are some very interesting brokerage notes that have come out. So I think it'll be important to talk about both the brokerage notes as well as the key stocks. Nikki and Somit join in for that. Good morning, both of you. Nikki, let's start off with the stocks in news first.
Sure, I'm going to start off with a development related to Yes Bank again. Nippon Mutual Fund and Axis Trustee, they filed a petition against the decision to write down Yes Bank ET1 bonds under reconstruction plan. Bombay High Court would be hearing these petitions on March 11. Just to give a lowdown, RBI draft reconstruction plan for Yes Bank had sought full write-down of 81 bonds. Overall, mutual funds and other bondholders have invested a sum of 8,400 crore in Yes Bank's 81 bonds. Also, we're looking at Lakshmi Bank, one more bank which is now knocking on RBI door. It says that the plan is to raise around $250 to $300 million, that is roughly around 2,200 crore or 2,000 to 2,000 odd crore through a sale of 49 to 60% stake in the bank. The bank's capital adequacy ratio is below the minimum requirement right now. We are also looking at Wonderla Holidays, which has decided to temporarily close the Kochi Park from March 11 to March 20 in view of the emerging cases of coronavirus in Kerala. We're looking at Granules India, which has come up with a plan to raise as much as 250 odd crore, which roughly forms around 4.5% to 5% of the overall capital, and the record date for the buyback has been fixed at March 20.
Okay, we'll watch out for these, and yes, certainly remains in focus. Do watch out for that one. We'll talk about that in a bit. But some very interesting brokerage notes that have come out.
Well, a couple of them. The first one is on GAIL India, where Credit Suisse has downgraded its rating on the stock to underperform from an outperform rating, and have also cut the target price to 88 rupees from 171. Now, according to the brokerage, the sharp fall in crude prices will likely lead to losses in the trading segment of the company. Now, the brokerage is concerned on a potential loss of nearly $500 million on the US LNG contracts, and also because of the lower profitability that we will see in the LPG segment of the company. Now, it is also expecting slow gas demand pickup as the prices of alternative fuels will also decline going forward. And on the back of this, it has cut its FY21 and 22 EPS estimates by nearly 25% and 29%, and has also lowered its valuation multiple for the transmission segment of GAIL India. The second one is on Reliance Industries, where Macquarie has upgraded its rating to a neutral from underperform, but have cut the target price to 1,145 from 1,300 rupees. Now, the cut in target price by Macquarie is because they have removed the Aramco DIL premium, which was ascribed by them at around 140 rupees per share. Now, this is because with the decline in crude prices, Saudi Aramco would potentially be defensive in terms of the cash flow and investments going forward. However, the sharp fall in share prices was the reason behind the upgrade in the rating for Reliance Industries. Now, the brokerage continues to see a consensus earnings downgrade risk going forward. It is expecting an 18% fall, even if the GRMs, which are currently trending lower, end up flat compared to last year. Despite this, they are expecting an 18% consensus earnings downgrade going forward.
Okay, we'll watch out for those. Thanks a lot, both of you, for giving us those updates. Coming on this one, Rasmik, Reliance Industries, that big drag on the markets. I mean, even otherwise the markets are down, but Reliance added fuel to fire. Did you ascribe any premium to a potential Aramco deal? Are you reviewing that? And what's the call on Reliance now that the stock has corrected so much from those highs of 1,600 all the way to levels that it is at right now?
I think our house, as a house, we have not put in so much a value of Aramco deal over there. But I think so that was one potential driver and trigger for the company, because that could have led to almost a huge cash flows, and could have led to improvement in the debt equity ratio and so on and so forth. I think our thesis of Reliance was mainly on Jio and the big upgradation in terms of better margins and better cash flows coming from Jio. But nonetheless, I think yes, this recent sharp fall in crude prices will materially impact GRMs on the refining side, and will also impact the profitability of the petrochemical segment. So I think we have a very high price target of 1850, which probably I think we could see some bit of cut in those. on the back of this development on the crude prices. But nonetheless, I think somewhere around 1,100, I think we see Reliance should bottom out, and it could be a great buy in this market in this space. I think, and similarly for some of the city gas distribution companies also, I think we are turning very positive, especially on Mahanagar Gas, because I think they'll also have the benefit of lower input cost, whereas we will not see mass cut in prices on PNG and CNG materially going forward. So they could see a bit of improvement in margins. Apart from that, I think oil marketing companies will gain a lot on account of the marketing margins that will go up in spite the refining margins going down. The positive impact of sharp jump in marketing margins will be far higher than the losses they'll make on the refining side. So that's one more space we're liking. And yes, downstream companies will have negative impact, oil and ONGC. That's the summation for this space as such.
Okay. Let's bring in our technical experts as well. Chandan Taparia, Associate Vice President, Motilal Oswal Securities, is joining us right now on the show. Chandan, thanks very much for taking out the time. We've got this big cut on Monday's session. Today's session most likely will be in the negative as well. What's your take on the levels that one needs to keep track of?
Yes, the sentiment and the structure of the Indian markets are negative. We have seen the formation of lower top, lower bottom formation on the weekly scale, and market is corrected by more than 2,000 points in just 14 trading session. It has recently broken the support of 10,650, which used to be the earlier swing low in the market. So as of now, till it remains below 10,650, 10,750 zone, weakness could persist to us 10,200 to 10,000 levels. In fact, the put OI also shifted to 10,000 in the weekly strikes, and we have seen built up of short positions. FIs are continuously selling from last 11 trading sessions. Put call ratios fallen from 1.21 to 1.04 level. So all such indicators are indicating the sustained call writing, built up of short position, and the negative sentiment could drive the market on the lower side. So till it remains below 10,650, we are expecting it to go down further to us 10,200 to 10,000 zones.
Okay. Anything with regards to the Nifty Bank, Chandan, because that's been the one that's been clobbered off late.
Yes, Bank Nifty is also seen the sharp selling pressure. It has broken all immediate support, making lower top, lower bottom formation. Most of the banking stocks are under pressure. It has broken even the swing low support of 27,250 zone. So 27,250 could act as a hurdle, and till it remains below the same, we are expecting it to go down to us 26,000 to 25,550 level.
Okay. What about individual stocks, Chandan?
Yeah, stock wise we have seen the advance decline ratio is negative. 90% stocks are forming the negative price pattern and making or breaking the immediate support trend line and holding below their immediate moving averages, because the sentiment and the structure of the most of the stocks has gone negative. However, we have gone to the deep oversold territory, so bounce could be seen, but better to be with the trend and better to be with the stocks which are making the fresh breakdown. So recommending to sell on Petronet, which is stop loss of 230. Here expecting the target was 210 levels. Petronet has given a breakdown on daily and the weekly scale, broken its rising support trend line, making lower top, lower bottom on the daily, weekly and the monthly scale. So Petronet, we are expecting it down to us 210 level. Second trade, there is sale on the RPL Bank. Already this stock has seen the correction of around 20% on the last trading session, but relentless selling in the counter indicates that further weakness of 15 to 20% cannot be ruled out. The stock has broken all immediate swing lows and trading at the new lifetime low territory, and significant short built up in the volume in last two trading sessions indicates weakness could be there. So recommending to sell on the RBL Bank with a stop loss of 217 and expecting it to go down to us 190 to 188 levels.
Chandan, just one quick follow-up question on the oil and gas majors. Almost all of them corrected except for the oil marketing companies. Which stock looks the weakest? Is it GAIL? Is it Reliance Industries, or is it some other?
So if you talk about the weakness, I think the GAIL looks weak. However, Reliance has also gone down, has broken immediate support zone. But medium term, long term and the short term trend for the GAIL is negative. So safety is there to sell the GAIL. We believe that GAIL is also now drifting below 100 levels, and once most of the stock goes below 100, hardly they recover. So that is also one more logic for the being weakness in the GAIL India. So 105 is the resistance, and the stop loss can be used to sell the GAIL, and here we are expecting a decline to us 90 levels. Talking about the Reliance as well, it seems that the stock has potential to go to us 1070, 1080 level. So GAIL looks more weak, but more weakness could be there in the Reliance because the structure has gone negative.
keep in mind GAIL would be the other important stock as well. Rasmik, do you guys have Gas Authority of India within your coverage? And the reason I bring this up is because now people are talking about whether or not those lower priced, they would have to reprice the LNG contracts and suffer losses on some of those as well, because the demand will be at the current spot prices and not necessarily at the elevated prices. I think there is a Credit Suisse note which speaks about the possibility, or a Macquarie note which speaks about the possibility of this happening. Do you guys cover GAIL? What's the view there?
Yes, we have. We cover GAIL, and our rating has been a buy and a positive view since a long time. But I think this recent crude impact is just few days event. So probably we'll see some cut in earnings and price targets also over there. But I think one needs to just keep in mind that the stock is also corrected both in terms of price and valuation very sharply. It's trading a multi-year low valuations. For the last 15 years we have not seen these kind of valuations, maybe trading at around 5-6 times now, and probably I think somewhere maybe around close to 90 or somewhere the stock will bottom out. But the only problem with most of the PSUs, the interest in PSUs is not there in the market. So the stocks are just drifting down, on a daily, weekly, monthly basis. So that's a bigger concern, I think. So lack of interest in PSUs, coupled with yes, some uncertainty on the LNG contracts, because I think GAIL, probably the weakest point for GAIL is the LNG imports they're doing from US. That's actually one area where they're not making money, and probably going forward that could actually hurt the earnings also in a big way. But I think even if we cut the price target, still the target for us could be way above the current market price. So right now everything is negative for the stock. So obviously we'll see a bit of breakdown, probably maybe going below 100. But somewhere I think in the next 1, 2 months, 3 months, you'll see some bottom formation in the stock also, anywhere between 90 to 100 rupees.
Okay. That's GAIL for you, which has been down about 7% in Monday's session. Want to look at SBI as well to see what that stock's been doing. In stock around the SBI Cards IPO, which gets listed on Monday, was anticipated to factor that in and trade somewhere closer to about 350. But now, obviously, the market sentiment itself, as well as the latest development in the Yes Bank, has put pressure on the stock. 253. Rasmik, would you feel that this is a good buy for you, SBI at 253?
Yeah, definitely. I think we are very optimistic and positive on SBI at current prices. I think so somewhere 245, 255, I think closer to 250 it should bottom out, because you've already seen the pain points and all the negatives getting factored in to a large extent. And going by whatever we've heard about Yes Bank, I think at least right now what we're seeing is the kind of investments are restricted. So to that extent I don't think so. And plus the management has clearly denied any merger of Yes Bank with SBI. So there's no it's not going to be a subsidiary. Obviously it's going to be a 49% investment. To that extent I think the company will be independent, and whatever losses come in I think could be limited to that company itself or bank itself. So if I look at all the sum and summation, huge deep value in SBI. If you're looking at actually the two listed companies which are already there, SBI Life and going forward you have got SBI Mutual Fund also supposed to be coming for listing in the next 1 year or so. If you're doing a lot of sum of parts, then there's a deep value in the parent itself. And anyways, we have gone through the worst pain cycles of the banking system in the last 2-3 years. I think for me, two biggest headwinds in the markets were two: outlook on faith of Yes Bank, which is at least it was like a big event which is diffused to a large extent and kept under control by RBI and the government. And second is we'll have to just wait out Vodafone, what's the outlook, because 17th March is the court hearing. What news articles are coming out saying that the government will try and give some reprieve for the sector. If Vodafone actually survives, then I think so systematic risk in the entire system probably is taken care. And once this dust settles down of this COVID-19 coronavirus, I think things will just be better off in the economy and for the banking sector. On overall, not only SBI, we are extremely positive on the entire BFSI space at this level, because you've seen most of the correction potentially which could happen to a large extent has happened. Companies where there were some doubts, issues, they've been punished severely. We've seen the correction in RBL, IndianOpen Bank also. So I think whatever worst you could have anticipated is already getting built into stock prices as of now.
I wonder if Yes Bank would become a part of that piece now as well. I mean, Yes Bank, until this SBI resolution happened, Devina, a completely different piece altogether. And we've refrained from talking about that so much on air too, despite the volatility, simply because it was difficult to ponder what would happen there. But, well, there's a lot of reports which speak about how there's a bevy of investors lining up along with SBI to take stake there. And whether or not this becomes an interesting stock to look at from a slightly medium-term perspective.
Honestly, depending on risk appetite, that's a call you take, or you just wait it out till you actually get a firm affirmative on the kind of people that are ready to invest in a bank like Yes Bank, because it's a zero net worth bank. I mean, if you're getting, based on whatever reports that you hear, if you're getting a valuation of about 5,000 odd crores on a Yes Bank, that's still a tall order in terms of its maintaining its business and operational performance post the moratorium coming off, and whether or not there's a run on deposits. And that's probably going to be the case. 14th of March is when you have the results of Yes Bank, which is anyone's guess what they're going to throw up in terms of their numbers. So ahead of that, I mean, it's just too many risky propositions to actually keep in mind. But obviously, a trader has its own view.
No, I mean, so the trader view is one thing. Rasmik, purely from somebody who's looking at a bank which has got a banking license and some possibilities of operations continuing because there is a State Bank of India now backing it. Is this something that you would look at? Is it possible to dissect the fundamentals and then look at Yes Bank? Or if you're taking a bet on Yes Bank right now, it's more of a punt?
I think I will go with the punt. It could be a punt only because too many moving parts, too much of uncertainty still surrounded for the bank. I think even if the net worth goes to around 25,000, the NPAs and the book below BB is almost around 42,000 crore. So what happens if almost 50,000 crores of NPAs come in the future, and again the net worth gets wiped off. So again you are back to square one. And even if actually you do, if just to give an example, if the book value itself comes into single digit, and even if the price remains in double digit, I think you will be staring at a 2-time price to book. Now in today's market, when good quality banks have corrected very sharply, and if you're getting an ICICI Bank or Axis Bank at 2 times price to book, I think people will still, I think one should still be with these certain names, where at least, there is no uncertainty, you don't know what's going to happen tomorrow. So given all this, I think I will still refrain from looking at Yes Bank. Probably it's better to look at some of the beaten down good quality banks and NBFCs. I think like HDFC Limited or probably HDFC Bank, ICICI Bank, Axis Bank, Cholamandalam Finance. So many names which come out and which look quite attractive. Where at least you can have a path where you can compound money at 25% from year on because of the beaten down prices and valuations.
Sure, and just on Monday we were discussing how HDFC Bank's price to book has been the lowest in the last 10 years. So if you're ready to buy an HDFC Bank at a much higher price, what's wrong with the price right now? But again, it's an individual call that you take, no recommendations being made here, but definitely attractive in terms of valuations. It's gone sub 3 times book, so 1107 on HDFC Bank. Chandan Dabaria, 2 stocks, quick calls on them, HDFC Bank being one and the other one being Bajaj Finance. That too has come off almost 18% from its recent highs.
Yes, first talking about HDFC Bank, however the stock has been making lower top, lower bottom on the weekly and daily scale. But good part is that on last trading session the stock witnessed sharp recovery from the lower levels. It recovered by around 3% from its intraday low. And somehow it is respecting to its multiple support of 1065, 1069, which made in the August 2019. So I think because of this support, some sort of stability could be seen. So looking for some bounce, 1065 is the support. In case of bounce, it can go to 1150 level. And talking about the Bajaj Finance, here also we have seen a small recovery because we are near to multiple support. So suggestion is better to look for some bounce with their multiple support. 3950 is the multiple support for the counter, and if it manages to hold, the recovery could be seen to us 4200. So both the stocks are showing the negative sign, but immediate candles and the price setup indicates some sort of bounce from their deep oversold territory. So some sort of bounce cannot be ruled out in both these counter. And I think if these stock recover, then some sort of stability could be there in the falling market as well.
Okay. We leave it at that. Rasmik, thanks very much for taking out the time. Let's talk a little bit more about the pre-open, which is in just the next few seconds. SGX Nifty, the close was down about 1%. Nifty 50, 10,000. We're not getting the rates yet, so I think we'll have to wait for those rates to stack in. But I'm definitely going to see a slight negative bias kicking in this morning. We missed our trade yesterday. It was pretty volatile across the globe. So just wait and watch. Currency is also going to be important. That one breached 74 to the dollar, and in the session, it's an important watch. Aside from that, all of the other movers on Monday's session, Reliance Industries that wiped out $13 billion in market cap in a single trading session. Whether or not there is any kind of a rebound that comes back into that counter, because that contributed almost 140 points to the total 560 point dip that we saw on the index itself. I don't know whether we're getting those rates, but nonetheless, just keeping it with some stocks then. And, Chandan, if there were a few names within the banking pack, I think we started getting the rates. It's a positive 0.25% on the Nifty. Sensex has moved up as well. I think that's showing you a bigger gyration in terms of the pop. That's up about closer to 2%. But again, volatile, so watch out for that. Yes Bank is showing you a 10% pop on the upside to 23.35. Reliance Industries has moved up. Bajaj Finance is up 3%. ICICI Bank's up 5%. Bharti Airtel is up 3%. Again, first few seconds, wait and watch. Hero MotoCorp, Adani Ports, Indian Oil, Asian Paints. This one is not budged actually. Asian Paints has done really well through this turmoil that we've been seeing. And a BPCL is up 0.25%. There is more red than green. So Wipro is down 10%. Infosys is down 3.5%. May not be Wipro. It won't stick with the 9% cut. M&M is down 2.5%. Bharti Infratel is down 2.8%. Z is down 2.3%. Tech Mahindra, Maruti Suzuki at 61.17. Grasim, Axis Bank, HUL, Power Grid are some of the other losers in the session. And then you have the likes of Sun Pharma and HDFC Bank too looks weaker again in today's trade. 73.87 to the dollar is where we are at. So there's some strength that's come back into the currency. Broader market space, breadth is almost flat.
Yeah. Well, Manappuram Finance looks like starting off weak, though these rates may change, so don't give them too much of importance. These rates will certainly change. I do want to mark what the Gas Authority of India is up to, and that stock should come up on your screen. It's a big downgrade, likely starting off 4.5% lower. Let's wait and watch. And we will watch out for the PSU banks. All of them cracked in Monday's session too. Let's see if there's some more downside for the central banks, Bank of Baroda's of the world. State Bank of India is a different kettle of fish. Some of the others could be interesting. But let's give these rates a chance to settle before we talk more about them. Keep in mind, Yes Bank, that one is about 10% higher yet again on open. Let's wait and watch how this shapes up during the course of the day. Okay, the currency, as we've marked already, starting off slightly stronger. The dollar has weakened across other currencies as well. But the question is whether this strength in the rupee will be sold into or no. The bond yields likely should be remaining soft. Chakri Lokpriya of TCG Asset Management joins us right now on the show with his thoughts as well. Chakri, good having you as always. Thanks for taking the time out today and on such short notice. Chakri, you reckon we could see some stability at these levels, or will it continue to remain choppy? Because if the US markets are anything to go by, it's very difficult to take overnight positions.
Good morning. The US is down about 15% so far year to date. Nifty is down more or less the same amount, same percentage. And India has a triple whammy in terms of more than Corona plus the global weakness. And in addition, we have a banking weakness. So against this backdrop, I think it's not time to nibble in. I think it's best to wait by the sidelines.
Okay. The other question that it brings to the mind, Chakri, and I'm glad you've mentioned, is that maybe staying on the sidelines at certain cases might be a good idea too. Are you in the process of identifying pockets which could eventually make you interested in dipping your toes? I mean, are these the usual winners, which have corrected the likes of HDFC Bank, Bajaj Finance and some of the others, because all of them have come down too? Or would it be spread across a slightly broader spectrum?
In the current environment, what I think we would like to do is basically continue to stay away from financials, even though they have corrected quite a bit, and start looking at companies which will actually benefit from lower input and crude prices. Companies like chemicals, cement, paint, all these companies have a direct proportion, directly fall their raw materials costs in relation to as crude price falls. Oil is down about 52% year to date over the last 12 months, notwithstanding the 20% fall you had in the last week. So against this, I think the input costs will come down dramatically. Yes, there will be demand destruction as well in India, but that kind of offsets each other. So those are the spaces that we will look to add on incrementally over time.
What about cyclicals, Chakri? Stay away from them?
The industrials, I think we should continue to stay away, because there are two things which are happening. One is you have a lower industrial activity in India. Now there is going to be lower industrial activity outside India. Companies like L&T, which get export orders, are likely we're going to see a temporary halt to those orders or a postponement. So the valuations are weak, so incrementally would we add? Clearly not.
Okay. The other point being, some of these PSU, public sector enterprises, ONGC for one, valuations being the cheapest that you're seeing it, but there's no takers. What would you do with some of these names? Because, aside from the fact that they've been touted as dividend yield companies, the stock price value destruction has been so high that it's not a selling point anymore.
You're right. ONGC, Power Grid, GAIL, Gas Authority of India, NTPC. Name all these companies. Now, all these companies have changed their stripes. The government made ONGC by HPCL, wants to break up GAIL into 3 or 4 big companies. NTPC by name is a thermal company, and now it's going to do solar. So when things like that happen, institutional interest from outside India dramatically goes down. Valuations are unimportant, because then what are you valuing? Are you valuing it as a thermal company? Are you going to value it as a solar company? And then you don't have any clarity over the pricing. In the case of companies like NTPC, what's going to be the PPA agreements? And in the case of companies like ONGC, there are multiple cross holdings. So in these kind of companies, valuations can go far, far lower and yet remain unattractive for a institutional holder.
By the way, the pre-open rates have settled down and tech is taking a beating. Wipro is down about 5%, Tech Mahindra down about 3.5%. I don't know, this spreading of the coronavirus, which President Trump was supposed to address as well, and he didn't, in the US, is making is a factor out here or something else, but IT is certainly taking it on the chin. The two names which are actually doing well, surprise, surprise, Yes Bank and Vodafone Idea. Both of them are up in Monday's session too. In today's session pre-open, Yes Bank is up 10%, Vodafone Idea is up 10%. So there's a big move in those beaten down names. But watch out, Reliance Industries should also be a stock that you should focus on. Chandan Taparia, coming on the oil marketing company stocks, they seem to be doing reasonably okay, bucking the trend in Monday's session. In today's session, IOC is starting off okay too. Is there a trade into any of the oil marketing companies?
If I look at the three stocks, BPCL, HPCL, IOC, BPCL shows more strength comparatively. Interesting fact, BPCL and HPCL has formed a short-term double bottom formation on their lower degree chart. So I think because of that, some sort of recovery could be there, and decline in the crude from the higher levels also have some positive sentiment in the counter. So 408.9 is the support for BPCL, and stock can attempt to us previous day high of 454, 460 level, and similar kind of setup is visible in Hindustan Petro, where support comes near to 202 for an upside to us 230 kind of levels.
Okay. Chakri, you spoke about this question on PSUs and the fallout there. What about the MNC companies? They were the darlings. They were getting bought into at exorbitant valuations. They too would have come off a bit. Are there pockets within the MNC space which, from a business-wise, look attractive and you might want to consider them?
No, indeed. If your companies like all the staples, in spite of their valuations, I think are clearly safe havens one would buy into. IT companies, even though they're not MNCs, but they are still relative safe havens because these are companies which have extremely good processes in place for distance working from home, offshoring, all disaster management setups. All these things are extremely well set up for both MNCs as well as for the Indian IT companies. And they would be able to cope far better and in fact deliver. There wouldn't be much of a revenue or EPS risk. Yes, there will be some cut, but not anything which will not come back in the following quarter. So I think in spite of the valuations of the MNCs, clearly yes, because their processes are far more robust.
Okay, minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. First up, Nippon Mutual Fund and Axis trustee filed petitions against the decision to write down Yes Bank's 81 bonds under reconstruction plan. Bombay High Court to hear the petitions today.
Biocon is in focus as the US FDA has accepted biologics license application for Mylan's Avastin, which is used for the treatment of cancer, according to Bloomberg.
Wonderla Holidays has decided to keep its main theme park in Kochi shut from today till the 20th of this month in light of the coronavirus cases in Kerala.
Future Retail says break-even for small stores will be achieved by September 2020 and first 7-Eleven store will open by April 2020 in Mumbai.
Macquarie upgrades Reliance Industries to neutral from underperform but cuts its target to 1145 from 1300 after assuming that the Aramco will be unwilling to pay a substantial premium for the proposed stake buy.
Citi maintains a sell on PNB and cuts target price to Rs 40 from 59, saying stress remains high to watch out for integration challenges for the merged entity. The stock unchanged in free open. 3.5 minutes left to go. Chakri, while we've been talking about some of these cyclicals, and I want to focus on autos which have been written down completely in this move down, in this correction that we've seen. The likes of Maruti, while Tata Motors, has seen the pain and the pressure building up because of the kind of pressure China brings in. The others, two-wheeler space, Bajaj Auto, Hero MotoCorp, and even a Maruti Suzuki for that matter. I mean, the pain has been a bit more exaggerated here. Do you feel that probably it's time to even start nibbling into some of these names?
All the names that you mentioned, whether it's Bajaj, M&M, Tata Motors, all the valuations are clearly at trough levels. When I say trough, they all are trading at their 2008 lows. And today the world is in a far better shape than it was in 2008. Now, then what is the problem? You have an EV supposed cycle coming up at some point in the future. Well, now that's debatable. If oil remains in the 20s and 30s for a fairly long time, that kind of pushes back any kind of an aggressive EV implementation. But more in the near term, all the BS4 vehicles with each one of these companies, some of them still, are being sold at a fairly hefty discount. When there's so much uncertainty, and while these are all passing, the corona is just a passing phase, but clearly during that passing phase, the sales are likely to be lower than expected. So you're not going to see a demand catalyst. Valuation is the only catalyst. So it's maybe you can nibble in, but not go all in. Okay.
That's for the auto pack. We spoke about some of the companies like Paints, and you mentioned some of them. These companies, and particularly Asian Paints for one, held fort strong in this correction. Right now, there's not even an iota of pain that you're seeing with regards to even selling because the valuations are high. People are still holding on to these companies, irrespective of the fact that some of the other good companies have seen profit taking. Some of these companies, not at all. What's your take here? And do you feel that at these levels, again, fresh investments, if you have to nibble into it, Asian Paints and some of these names are good to be in?
If there's incremental cash coming into the system for funds, and I think this is the space that funds would gravitate to, simply because for all the now the titanium dioxide and other input costs are even lower than they were a month ago, making them more margin accretive. So whatever shortfall you might see in demand, that is the top line slowing down, is likely to be made up in terms of a better margin of these companies in the coming quarter. So this is a fairly good reason when we're staring at a sector at a quarter where there's likely to be weakness across board. I think these kind of companies, including some of the chemical companies, they might take a revenue hit, but they are going to see the earnings to be fairly intact.
Okay, stay on. Chakri, take a moment to thank you, of course, for joining in today. Chandan, just stay on. We'll take in your opening thoughts post-market open, but here's how we're starting off. About 1% lower for the Nifty, the Sensex down about 360 points, and the Nifty Bank, well, maybe behaving slightly better than the Nifty and the Sensex, but down about 0.8% nevertheless. So for people who are surprised, well, the Dow futures were already indicating this, so keep that at the back of your mind. The US markets, while went up yesterday, were not quite active as we speak. Nifty mid cap down about 0.5%, small cap index flat right now. Let's see if this changes, but there is pressure for sure. Bring up the heat map and show you what's moving and what's not. A lot of red, very little green. What is in the green? Yes Bank about 10%. ONGC and Reliance bounced back. Both of them were clobbered, literally clobbered in trade on Monday at 15% and 12% respectively, and both of them bounced back marginally today. Oil too, by the way, has moved up a bit. Asian Paints 0.5% higher. Bajaj Auto, Hero MotoCorp, so those two might rise higher, and Bajaj Finance is showing some hint of green, but aside of that, not too much. HDFC Bank is in the red, ICICI Bank is in the red, and almost everything else is in the red too. IT is taking a bit hit. The biggest loser though is Infosys, down about 4%, and GAIL, which is now down about 5%. The note from Credit Suisse speaks about the possibility of a large loss that they may have to accept because of the LNG contracts, and therefore GAIL is under stress. But IT is that big pocket under stress today. Infosys, TechM, HCL Technologies are all in the red, and there is weakness in HUL and ITC too, down about a couple of percentage points apiece. So, yep, the heavies or the defenses are now getting pinned back. And well, surprise, surprise, the quantum of green on the screen is increasing. The Nifty 2 is off the lows of the day. So that's the sum and substance of really what's happening here on the large cap space, or at least not really on the large cap space, but on the Nifty. Yes Bank is in the green, Reliance is in the green, and that's the highlight for this morning right now. Devina, what about the broader end of the spectrum?
Well, a few names that are moving alongside are Vodafone Idea, which is up about 8.7%, Dish TV, which is up 7.5%, Shipping Corporation of India is up about 7%. You've got RBL Bank that took a knock of 22% on Monday's session. That is bouncing back a bit, so that's up about 4.5%. Lakshmi Vilas Bank is up about 4.6%. You've got Trent. Remember, Trent is one of those names where we've had a consensus buy call throughout. And in terms of the business potential, the stock's up about 3%, and this too has corrected to decent enough levels. Avanti Feeds 4% higher. You've got this stock also got decimated over the last few days, and now it's regaining some lost ground. Parag Milk Foods down up 3.5%. You've got TV18, then UCO Bank, Vakrangi, South Indian Bank, Welspun Corp, United Bank, some of these names that are doing okay. L&T Fin Holdings is up 1.7%. First Source Solutions, Allahabad Bank, Tata Coffee are some of the names that are gaining ground in today's session. What's losing out is a Corporation Bank. That stock's down in the session, I think closer to about 5.5% lower for Corporation Bank. Tech, JP Power, Kansai Nerolac down 5%. Indiabulls Real Estate down 5%, Indiabulls Ventures down 5%, Gold Future Consumer down 5%, and Suvan Life and Divan Housing down 5%. Breadth of the market still more positive than negative.
Well, the Nifty Bank is in the green, so that's pretty interesting. Chandan Thapar, your quick opening thoughts on a stock that you would monitor as a top trade today?
Yep, again, the good part is that we opened negative, but some recovery was seen. An important part is that we have not seen major jump in the volatility index right now. Volatility index is just flat, is near to 31, so that indicates some sort of consolidation could be there in the market. So that is a good sense as of now. Talking about the trading ideas, first trade I'll focus on the Pidilite. However, in the morning we discuss about two negative trades, including Petronet and RBL. So I'm negative on the Petronet, but one positive trade here I'm getting on Pidilite. This stock is one of the strongest counter, and I believe if market recovers, this stock can do well. It is trading near to 1650. One can put a stop loss of 1620 for an upside move towards 1700, 1720 levels.
Got that. We leave it at that, Chandan. Thank you very much for joining us this morning with your thoughts on the markets. The index for itself is holding pretty steady. Right now, no major cuts. The Nifty Bank is back into the green by about almost 0.5%. Mark Matthews of Julius Baer Bank, Julius Baer is joining us right now on the show. Mark, thanks very much for taking out the time. It's a lot of different moving parts to digest and make sense out of whether or not investment is called for at this hour or no, or whether or not just sitting on the sidelines makes more sense. What's your assessment of what's been happening so far?
My assessment is that we probably have more downside because while the virus has been contained in China, and it looks like it's coming under control in some of the other countries that were early to get hit, like South Korea. It's clearly going to ramp up in Europe and in the United States. And the S&P is the benchmark for the global financial markets. And I think that it won't like large numbers in the United States, which are going to start coming out as the test kits are deployed across the country. And they'll have to go through something similar that South Korea went through in terms of mitigation and containment, and that'll cause concerns about the economy, and that's why the market is going down. But I don't know if we can say that it's all over yet.
According to you, what is the bigger threat now? Obviously, coronavirus being one, and the other one is being the collapse in crude oil prices. Now, no one is really expecting a V-shaped recovery even in crude oil prices. So how do you think that plays out? Mark? All right, I think we've lost that connect there, but we'll try and get him back online with us. Nifty itself has moved back into the green, so about marginal 10, 12 odd points on the Nifty 50. The Nifty Bank is moving up pretty strong, so another 182 points higher for Nifty Bank right now. A few names that got pummeled over this last two trading sessions. Vinity Organics was down about 12 odd % on Monday's session. Remember the crude oil collapse bearing down on Vinity as well. The stocks recovered a wee bit, about 2 odd % higher. Relaxo Footwear, finally sees some green after incessant selling that brought it down from levels of about 820 to 674. That's up about 2%. Deepak Nitrite continues to do well. That's up about 4 odd % in this session, closer to 4 odd %. Mark Matthews is back with us. Mark, sorry, I think we lost your link out there. My question to you was, between coronavirus and the fact that you're not going to be expected to see a V-shaped recovery in crude oil prices, for emerging market standpoint, obviously the fall in crude oil prices stands to be a big beneficiary for a country like India, since we're net importers. But which is going to be the bigger challenge to tackle right now?
Oh, the much bigger challenge is the uncertainty of the virus, because it has the potential to create a crisis like 2008 in the sense that, global markets could really sell off hard. And the oil price, obviously, it's not good for certain parts of the world which are already fragile, like the Middle East, but on the whole, it's a big benefit to the rest of the world. No, I think the virus is the much bigger issue.
Mark, we were just having a conversation earlier on with James Glassman, and he suggested that if somebody was dormant for a decade and didn't land up seeing the last 10 days of selling, they would wake up and still find the markets more expensively priced. And therefore, that suggests that, even post this correction, it's not like as if the markets are, cheap in terms of valuations. They're still more richly priced, which could be suggestive that there could be more selling pressure. Do you agree that markets are still a little elevated in terms of valuations?
Yeah, not just a little, a lot. For sure, markets are expensive because interest rates are so low. I mean, I suppose that's the key differential to 10 years ago. I can't remember what the Fed funds rate was back in 2008, but somewhere around probably 3 or 4%. And of course, now it's almost zero. So that is supportive for risk assets. But the fact that interest rates are so low could also be construed as a negative. You could say it shows there's something really wrong with the world when the 10-year Treasury is at 0.5, 0.6%. And I think one big risk is now that this whole thing is sort of happened with the sell-off, that we do see some of the pipes that deliver liquidity to the financial markets and therefore the economy somehow become messed up. And you can get sort of signals that might be happening in the credit markets when you look at the credit derivative swaps and the spread between the investment grade and high yield. They're starting to go up. So I think that's something we need to watch very closely.
All right. Mark, with regards to equity market investments, do you think that pipe is going to dry up now? While much of the money is being pulled out of the emerging markets as well, foreign institutional investors sold out $1 billion on Monday just from the Indian equity markets. Do you feel that trend will likely continue? And even though while we're talking of a sharper rally once the bottom is in place, the money that comes in from foreign institutional investors into emerging markets is still going to take its time.
Well, one good thing is that the dollar has gone down a lot, and I think it'll continue to go down a lot. And then we just talked about the oil price and how that's good for emerging markets like India too. So there are definitely supportive factors to emerging markets. I actually think, ironically, emerging markets could outperform, which they certainly didn't do back in 2008. But in 2008, they'd already gone up a lot. The emerging market complex has underperformed the S&P for sure over many, many years. So it could outperform, but still the S&P is that massive bellwether, and it's very, very difficult for anything to go up if that's going down, a lot, which I think it still has the potential to do.
Mark, good morning. Neeraj here. I'm just wondering, the point that you alluded to earlier, would you believe that a bit of a credit crunch in BBB and below book in the US could actually trigger fund outflows of a nature that we haven't seen thus far?
Yeah, I think that before this whole virus thing started, that most people felt if there was going to be a problem in the market, it was going to happen in the credit market, where you've had so many fairly low quality companies issuing paper. And the thought or the concern was that interest rates would go up and they wouldn't be able to pay. But it may be that they're not able to pay because global growth really slows down as a result of this virus and the containment and mitigation efforts that are meant to combat it. And therefore, these companies won't have the cash flow to cover their interest payments. So it depends on the government response, on the central bank response. They will try very hard, of course, to forestall a large jump in delinquencies and bankruptcies. But the potential is there if you see it's a sort of catch-22 situation, because if you let the virus spiral out of control, it's terrible. We all know that. I mean, the healthcare systems of the world are not equipped to handle this. But on the other hand, if you contain it, your economy will grind to a halt. So as I said, you can't really win in either situation. But I hope they go for containment. And the risk with the containment is that you do get an accident in the credit markets.
Mark, just the other question is, when it was knocking largely on the doors of China, the conversations around business dislocations were very wide. Now, while China is getting contained, this is spreading at an alarming rate across. When you speak to businesses, or when your team speaks to businesses worldwide, what are they talking about business dislocations? Are they happening at a faster clip? Will businesses find it very difficult to come back to their feet, or are things normal?
Well, the only place that really went for big containment, where we have a data series of over a month to look at, is China. And China's coming back fast. As you probably know, President Xi visited Wuhan, which is the epicenter of the virus, yesterday, and that was taken as a sign that the Communist Party feels confident enough that the virus is contained. They reported less than 20 cases in Wuhan yesterday, which is, a month ago it was several thousand. And if you look at the metrics like, there's various metrics you can look at to show that business is normalizing in China. And when you speak to factories in China, they say, anybody who wants us to give us an order, we're happy to make whatever they want. The problem is the other side of the coin, that we don't know what the fallout from this is going to be in the West in particular, in Europe really in particular, in the United States, because we don't know if when governments try to impose these very strict containment measures, if people will listen to them. I mean, in China, they're used to taking orders from the government. In the West, they're not. And so it's very, very complicated situation, but the supply chain, I would say, has not been disrupted yet, because really the only country to do very, very draconian measures in the West so far has been Italy.
Mark, since you mentioned that this time around, once the bottom is in place and once the pickup kicks in, emerging markets will most likely outperform. What's your favorite market in the list of emerging markets? I mean, what would you stack them up as the most incrementally beneficial market that you feel can outdo?
Well, it's probably not very interesting for your audience, but I've been watching Thailand for what it's worth. The Thai market's down about 25% so far this year. And that's because they get a lot of Chinese tourists. I think 1 in every 3 tourists there was from China. Of course, they're not going there now. And their big stocks are oil stocks. But I think it's a good place. It's got a good dividend. It's got well-run companies. So as I say, it's kind of probably too small to be interesting for your audience. But I think Thailand looks quite interesting at this point in time, because it is down 25%. China's not. I mean, China's basically flat on the year.
We've got some positivity in the Indian markets today, Mark. Just wondering, one quick follow-up on that, since you brought up oil stocks and what crude is doing. That's the other joker in the pack. The common theory is that with crude prices coming off the way they are, it's great positive for the oil importing countries. The question is, because it's so volatile, and because some part of the Indian stocks as well get benchmark against crude, Reliance, for example, and therefore it puts the Aramco deal in jeopardy. Do you reckon that while in the medium term it could be a positive, in short term it only adds to volatility, or would you largely construe this as a positive?
Oh, I largely construe it as a positive. If you take away Reliance and Vedanta, basically India is a huge beneficiary of the low oil price, and the current account deficit will probably be below 1% as a percent of GDP, and RBI has a lot more ammunition. It's really great. The low oil price is wonderful for India, and India looks interesting in pockets for sure, but it's still got what should I say, issues, particularly with the banking sector, and so I think it's starting to look interesting, India, but I wouldn't be rushing in quite yet.
All right. Words of advice there. Mark, thanks very much for joining, and really appreciate you taking out the time this morning. All right, Indian markets then holding steady, about a 0.6% bump up on the Nifty this morning, 10,517, while the Nifty Bank is up about 1% today. Helped primarily by Reliance Industries, which is up about 5.5% amongst the key heavyweights. IndianOpen Bank was up about 2.7%. I want to quickly look at the point contributors at this hour to just get a gauge of which direction and what's helping the index at this point. So Reliance Industries, obviously, within the 125 odd point bump up that the Indian Nifty is seeing, Reliance is contributing about 50 points to that. ICICI Bank is contributing about 12 odd points. HDFC Limited and Bharti Airtel are the ones that are drawing, that's got top draw in terms of market participation on the upside. On the downside, IT takes a little bit of a knock, and HDFC Bank and Kotak Mahindra Bank continues to reel under some amount of pressure. Good time to bring in Andrew Holland, CEO at Avendus Capital Alternate Strategies, joining us right now on the show. Andrew, great to have you. We've not spoken since the time we saw the index peak out and start its spiral move downwards. What's the gauge on equity investments right now? How should one proceed and tread this volatility?
Well, I think everyone should proceed with caution. It goes without saying, really, given the volatility. I think this is a pretty much a defining week, because I think markets really now are expecting a coordinated and global response, whether that's monetary and fiscal as well, to this problem, because it's not just a China problem anymore. It's a global problem, and we moved from those kind of expectations that it was just a China problem there to a supply problem, to now really a demand problem, and I think that's what's spooking the markets, and they're trying to get a feel really for where global growth and earnings might end up, and I think the kind of the red pens in terms of the downgrades are still yet to kind of come to the fore. So I think the market's looking for some sort of stability or global response. It's going to have to be a targeted response as well. And then, we can start to kind of think about, if the number of cases is starting to peak in the Western world, then, what's the kind of landscape looking like, say maybe April onwards, in terms of what the downgrades will be and which sectors will come out of it stronger. So I think that's where we are. Everything at the moment gets tarred with the same brush. So it's worth just sitting on the sidelines a little bit to see what the first response globally is.
Andrew, good morning. Neeraj here. You reckon it will be a central bank stroke coordinated action from governments which will help us combat the issues surrounding credit right now and coronavirus spreading? Or would that be one of the measures which might just alleviate the pain a bit, not quite dispel the uncertainty due to the coronavirus?
See, it can't just be interest rate reductions. I mean, obviously that helps, but if you've got a demand shock in certain industries, then it doesn't matter how low interest rates are if you don't have the revenues and therefore the cash flows to pay back your interest, then you've got a problem. So I think, whilst interest rates will be one tool, I think the other tool will obviously be, kind of directing kind of credit or fiscal help to some of those sectors, which are under pressure, which obviously the kind of airlines, oil, travel, restaurants, small and medium-sized companies. So I think that's where the target needs to be, rather than just interest rates. Interest rates will help at the margin, but not when you have a demand shock. So I think it needs to be a response which is more targeted to those areas in the very short term. And I think then that would give the markets a little bit more a bit more confidence that the kind of credit risk which people are now finally coming towards, will not be as bad. There will be casualties. There's bound to be. But if it can be limited, then obviously that would be good news for global markets. I think my concern in the very short term is probably more towards the Europe and the banking sector there, which does have its own problems anyway. So it'd be interesting to see what the ECB response will be, but also in particular Germany's response to this outbreak, which they've been very quiet in the past few weeks.
Andrew, one argument that is being made is that if we look at the broader end of the spectrum right now, while the impact on businesses is not quite known as yet, but assuming that they were stocked up and therefore the disruption until now will not be that major, the indices themselves are very close to the levels that they were at in 2008, right? The peaks we made there, small caps, etc., 11,500, and therefore there might be merit in trying to start nibbling at some of these pockets, even if the larger view is that let's wait on the sidelines. Is that the argument that you would buy? Why or why not?
Listen, it depends on your kind of your time horizon. Yeah, there's some very good companies, there's some great value out there, but the fear is that they will get cheaper because we don't know what the response is and the volatility is too high. To say that the worst is behind us. I think there's a few things. One is, if you take that supply chain from China and say that's starting to pick up, the problem is it's starting to pick up into a demand shock, and therefore, it just leads to, the slowdown, which, again, if you go back just a month ago, you'll find most global forecasts were saying this is just a 0.2% hit on the global economy, and now we've quickly gone to 0.5% and more. So that's where the moving target is. So, you know, it's not going to be easy to say, you know, here's the right forecast at the moment on any company, you know, across the globe. So I think that's where the market's trying to factor in, you know, where's the bottom in terms of the earnings or global forecast, and we just don't have that answer. And so we're all grappling in the dark to try and find it. So valuations might look cheap, but obviously, you know, it could be on the basis that forecasts have not yet been actually kind of downgraded. So that, I think that's what the market is looking at. Well, you know, once the dust settles in all of this, and it does, you know, we do need to see that that global response. You know, and we haven't talked about oil prices, but if oil prices remain around these levels, then, you know, I think there's a change in how we might think from globalization to kind of local growing economies. And I think that's where India will stand out as being more defensive, which it is, and two, would obviously have a growing domestic economy. So I think that's the kind of outcome that you need to look at. But in between time, you're just going to be hit by by kind of news flow, which can be positive and negative. So I think, you know, sitting on the sidelines is not a bad thing in the very short term. And I'm talking about weeks here. I'm not talking about months and years. So I think just being a little bit careful is not a bad thing to do.
Andrew, do you believe that the RBI now has a little bit more headroom? Because while crude oil prices have come off, that will have a negative impact on crude price inflation, which gives it that much more of a leeway to tackle the growth issue. And the fact that crude prices at around 30-35 aid the Indian GDP by about 1.4%, that's an incremental positive.
Yes, it is, and hopefully again they'll bring down interest rates. But again, I think if they can target certain sectors, I mean they did last time around. They tried to target the kind of real estate, non-bank financial companies, but in particular the kind of small and medium-sized businesses as well. So if they can continue that kind of flow into those areas, I think that would be welcome from my perspective. So I think, you know, rather than just think about pure interest rates and that, it's really the targeting of industries which I think we'll all be looking for going forward. The RBI started it in the last policy, and I think they'll need to continue that. So I don't think globally and locally just reducing interest rates is the key. It's reducing interest rates, but also targeting the areas that need it and need it quickly.
All right. Let's talk a little bit more about, just protection buys, safer haven buys, consumption. That's the pocket. You've got Nestle, you've got Britannia, you've got the likes of Asian Paints, D-Mart or Avenue Supermarts, which have not fallen much. These are, do you go ahead with these kind of plays right now as safer haven bets? If you had the compulsion to deploy money, I know you said that it's not bad to just sit on cash for the time being, but if you had the compulsion to spend that money, would a part of it go to some of these allocations?
You see, I think, you know, that's a place to hide in these difficult markets, and no doubt, once we get through this, then these companies will continue to do well. So the best in class in each of your sectors is where you should be targeting, and that could be, in sectors which are suffering as well. So those are the companies you need to identify. Yes, you can hide in the defensives, but once markets turn, it's, whilst the defensives will obviously rise with the market, it'll be some of these other companies best in class in some of the other sectors which have been beaten down, which is probably you'll get a bigger return going forward in the very short term. So you just got to try and look across each of the sectors and say, is the worst behind us? If it is, then which companies down, which is best in the class, and which companies. So I don't necessarily say if you're going to deploy, it has to necessarily be in the defensives. It's a good area if you want to hide, but I would be looking a little bit below the traditional defensive stocks to say this is where I want to be for once the markets are less volatile and we can see the road ahead a little clearer. Then these are the stocks which would actually give you more outperformance in the shorter to medium term.
Right. Andrew, while we've been pondering over the exits from the foreign institutional investor, at the same time, domestic institutional investors have, if not been matching up, coming very close to matching up to the exits of the foreign institutional investors in terms of the inflows that have been coming into the equity markets. And now with the steady SIP monthly inflow that's been coming into the tune of about 8,300 odd crores, do you feel that staying out actually you may miss the bus because there is steady money coming into the equity markets on almost a monthly basis?
No, see, I don't, that's a very good point. But, the foreign institutional investors selling is very concentrated all in one go. And therefore, from a local perspective, I'm sure fund managers want to kind of spread that investment, in the falling markets and so forth. What I'm saying is that, just by sitting on the sidelines doesn't mean you can't participate when markets are looking more favorable, because even if you miss the kind of first few percent, does it really matter in a longer term kind of upward move? So I'm just saying, in the very short term, rather than be whipsawed by news which can be positive and negative, more so negative at the moment, you can just kind of quite happily just pick up your favorite stocks across different sectors, best-in-class companies, and then wait for the broader market, to kind of feel more confident that you want to go into the broader market, because there's a change in terms of how the outlook is globally and locally for you to do that. So missing the first few percent in a longer term rise, I don't think is a bad thing. Because we all love to buy the bottom, right? But you have to have a bit of luck to do that as well. So I'm not sure that I would kind of say wholeheartedly now you need to go in, because overnight you could have no news from Trump and then the markets will react to that. The markets will go down until they get the response they want globally.
Right. Yep. And till then, it's a coin toss as to which direction the market opens the next day. Thanks very much, Andrew, for joining in. Appreciate you taking out the time.
Pleasure.
Markets down in the red now. So, talking about coin tosses on a daily move, you can talk
on
about
an
it
early
for
move.
So down about 0.1%, 10,433 on the Nifty 50. Nifty Bank is back into the red after being up almost 0.75%.
Yeah, it's looking slightly choppy. Let's wait and watch how the day goes by. But we wrap it up on this leg of Indian Open from Devi and me and the team that put this show together. Thank you so much for watching.